Welcome to the Tactical Brief, the investors, speculators and traders. Today I want to talk to you about how can you pick the right stock to become a millionaire. What sounds like clickbait at first is actually based on a very sound concept, which we'll present it to you in a second by Anand Patipati, one of my old colleagues at Bear Stearns and dear friends, and he used to be one of the guys they brought in when we grunts on the floor couldn't handle our problems anymore, just to put you in the right mindset. Anand is going to talk to you about what he calls picking compounders and the criteria to choose these compounders. You've heard about compounding interest. It's pretty much the same, but he's trying to pick the right stocks which can deliver this awesome effect of compounding returns, far outsmarting the market. Additionally, he applies a margin of safety to his investments. There are also a couple of criteria he's following to do that, and he will explain in his presentation how he's doing this, what he's trying to achieve with it. And I think if past performance is an indication about what's going to happen in the future, he's following a fantastic approach there. And I wanted to share that with my students. Anand will read you the disclaimers. None of this is encouragement to invest in his fund or follow what he does. It's purely educational, but I hope you really will enjoy this video. I did it very much when I saw it the first time, and without further ado, I pass on to this handsome devil to give you the presentation on how to pick stocks that can make you a millionaire. Bye-bye.
Good afternoon and welcome to GFM Focus, and thank you for coming. My name is Anand Patipati and I will be presenting this webinar this evening. Thank you again for making the time. I see some friends and colleagues here. Welcome. I also see some new people. Thank you for joining us this evening. We appreciate your time, and my aim is to make this evening an insightful experience in your journey towards successful wealth creation. So with that, let me switch back to the presentation mode and start the meeting. Thank you. So this is our standard disclaimer. We are a licensed asset management firm in Hong Kong and the US, and this is purely an educational presentation. It is not investment advice, not recommendation to buy or sell any security or a solicitation of any kind. It's also not tax or legal advice. Please do not buy or sell anything based on the information here, and we are not responsible for losses in such an event, goes without saying. With that, you are welcome, though, to spend your time, learn a few things, and hopefully benefit from the experience. For those of you who don't know me, my name is Anand Patipati. As you can see from this slide, I've worked in too many banks, have too many degrees, and I've lived in too many countries. A few years ago, I set up GFM along with a good friend of mine and colleague. And basically, GFM Asset Management is a licensed investment manager. I manage GFM Focus Investing. I'm the portfolio manager and co-investor alongside our clients. At GFM Focus, we invest with the aim of doubling our portfolio value in approximately 3 to 6 years through high conviction, long and short investments. We operate like an investment partnership and not like a fund manager. Very briefly, we invest our own money alongside our clients. We are performance fee only, which means that we only get paid when our clients make any money, otherwise not. Each month, each client's money wealth account is held in a separate account in a third-party financial institution, and they can log in and check what's happening with their money at any time they want. It's only they can make deposits and withdrawals. Anyway, this structure makes us completely different from a whole host of asset managers like mutual funds or ETFs or hedge funds that basically tend to charge a lot of fees disconnected from the portfolio performance. We are the other end of that spectrum. So let's get started. I wanted to start off this presentation with an ancient story from India. It's 1500 years old. It's the story of chess. Well, what happened was the inventor of chess took it to the king at the time. The king spent some time and he fell in love with the game. It for him was like a simulation of all these battles that he was planning to fight and expand his kingdom. Anyway, the king wanted to reward the inventor and he said, you can ask for anything you wish. The inventor said, oh, thank you. I only want some rice. What I want you to do, oh dear king, is to put 1 grain of rice on the first square, then 2 grains of rice on the second square, and so on until you reach all the squares, 64 squares that are on the chessboard. The king laughed. He thought, what a fool. Here I was offering all the riches that he could imagine, and this guy only wants some rice. He said, okay, let's do that. Well, this is what happened. आजा आजा जिंद शामी आने के तले आजा जरी और नीले आसमाने के तले आजा आजा जिंद शामी आने के तले आजा जरी और नीले आसमाने के तले
Hey, unmute or mute? Oh, mute. Okay. Oh, seriously. Okay.
I am back. So I hope this video woke everyone up. My point is that compounding is not theoretical. Investing correctly in stocks is a fantastic way of multiplying your wealth over years and decades. This is why we call these presentations stocks that generate millionaires. These stocks are in every country, every sector, and they come by in every generation. Now, let us take a very quick look. Who doesn't recognize this picture? The person in this picture is Bill Gates. Now, Microsoft IPO was actually in March of 1986, but this chart is from 1990, well after the stock had gone up 600%, six times between 96 and 1990. But had you put in $100,000 in Microsoft in 1990 at what then looked like a super expensive price, 6 times higher than the IPO price, that $100,000, had you bought it in 1990 and left it there, today in 2020, you would have a very cool $2.4 billion. Think about that for 1 second. There were lots of people here who or whose families had $100,000 to spare in 1990. Maybe a few of them bought a nice car, maybe a BMW, I don't know. Today, that 100K would have changed your life and that of several generations in the future had, instead of that BMW, had you bought $100,000 worth of Microsoft stock. 30 years, my point, is not such a long time to wait for a portion of your savings to have a life-changing impact. This is my first point. Second point, why is Bill Gates here in this picture? He actually retired. He left Microsoft in 2006. He had nothing to do with Microsoft more or less after that. He was very rich back then. $50 billion was what he was worth when he left in 2006. Why didn't he just sell his shares and bank the money? I'm sure he would have received advice from investment advisors, private bankers, and so on to spread his risk, diversify, and so on. But Bill Gates only had one big investment, his stock in Microsoft. It's true even today. This stock, look at that chart, this stock did not do anything for a good 10, 12 years. Between 2000 and 2010, the stock was flat. It went nowhere. And then it just set itself on fire again. 10 years, when the stock did nothing, when most people today don't even have the patience to wait for 1 quarter when the earnings disappoint. Well, it's also the reason why Bill Gates is still in the picture today, because his investment is worth an enormous amount of money that came with the compounding effect that you see in this chart of 30 years. I know what most people are thinking, oh, it's Microsoft, Netflix, Amazon. Everyone here knows them, and these are the stocks where people got rich. Well, wrong. Here is an unknown company called Dialog Group in a commodity tough business of oil storage in Malaysia, not Saudi Arabia, Malaysia. Started by a person who's still unknown, Boon Kit Niao. 100,000 ringgit at its IPO back in the day would have been worth a very cool 536 million ringgit in 24 years. In fact, if you look at the rate of compounding, a 43% annualized growth, it's even better than Microsoft in the previous chart on a per annum growth rate basis. It was double your money every 20 months with Dialog, but you can see from the chart, the road was bumpy. It wasn't a straight line. There were periods where nothing happened. There were periods where there were paper losses. But in that 24 years, this man became super rich because he allowed the forces of compounding to work with him, and he allowed his wealth to grow along with the growth in the business. So we'll come back to this point in a second. China. Everybody here probably has heard of Alibaba, Tencent, Li Ka-shing, and these are famous people, successful businesses. Yes, no doubt. But look at this. Sun Pyongyang, how many people have heard of him? Jiangxiu Hengrui? I can't even pronounce the name properly. Apologies to the Chinese people here. In this very boring generic pharmaceuticals business, in just 20 years, this investment of 100K would have been worth a good $1.3 billion. And, I can keep going on. This is a company from just 12 years ago. 100,000 yen investment would have been worth a very cool 90 million yen, about 10 million US dollars. Started by a housewife and a secretary in a very unglamorous business of temp staffing. So we can keep going on and on. But my point is very simply this. These compounders, the stocks that generate millionaires, are everywhere. They're in every country, every sector, big companies, small companies, and so on. And yes, these really are the stocks that have generated millionaires. But, here's the big but. Most people, including most people in this room, in this webinar, have not and do not become millionaires by buying stocks for investment. And why is that? Well, I think this slide summarizes what it takes for you to allow the stocks to make you a millionaire. First, it takes a very long time. All those examples that you saw, 10, 20, 30 years, it didn't happen in a year, it didn't happen in a quarter. But the good news is that it just takes one stock to change your life. And Microsoft for Bill Gates, Parasol Holdings for this lady called Yoshiko Shinohara. So it just takes one stock. And you have to know the underlying business for you to think and act like an owner. All the people in these charts were business owners. None of them were traders. In fact, I would be willing to bet that there'd be very few investment managers who made millions off any of the stocks that I just profiled. But the good news also, yes, it is possible to outperform the market. In all those charts, there was a comparison to S&P 500, one benchmark of the stock market. And you saw all these stocks left S&P in the dust. But you can't beat the market by owning 200 stocks. It's just not possible. If you own 200 stocks, then you are the average, which means you are the market. But if you own 1, 2, 3, 4 special stocks and you let the forces of compounding work for you, then yes, it is possible to make an enormous amount of money. And, like the title says, stocks that make millionaires. So hopefully by now, you agree with me that yes, it is possible for allowing the forces of compounding to help you become a millionaire. But I'm sure you also are thinking that, I bought stock in the past, it didn't make me a millionaire, or even if I left it for 10 years, 20 years, it probably wouldn't have made me a millionaire. So here's a story that highlights how to spot a compounder, which then does generate millionaires. We start the story in 2004. Two companies came to the stock market, Google and SMIC. They both raised roughly the same amount of money. Both were tech companies. Both had strong pedigrees and so on. So let's imagine that you were there in 2004 and you had $100,000 to invest and you had to pick one of these two companies to invest in. Depending on which one you picked, here's the result 10 years later. Wow. Big difference. Look at that. That $100,000 would have been a very cool $1.2 million 10 years later in 2014. But had you picked SMIC, you would have probably not seen the stock 10 years later, because just in 2009, it lost 90% in value. And somewhere along this line, most people, including you and me, we would have sold out of the stock and said bye-bye. So anyway, continuing with the story, if you had put in $100,000 at the IPO in SMIC, by 2009, you would have lost 90% of it. It would only be worth 10K. And then it recovered. But after being like this long-term investor, everybody keeps talking about, buy and hold long-term, etc. After doing all that, 10 years later, your 100K would only be worth half. It's only worth $47,000. That's a negative 7% return per year. Meanwhile, the stock market, as expected, doubles approximately every 10 years. In this particular period, it was growing at around 6% or double every 12 years. Anyway, remember I said earlier that for you to allow the forces of compounding, you have to let the business guide you. You have to think like an owner and not like a trader. So here's some tools. The chart here profiles return on equity or the components of return on equity. So if you look at the chart on the left, it says net margin, and net margin is basically your net income, which is profits that the company has made or losses that the company has made at the end of the year, divided by the revenue of that year. The right one is revenue divided by equity, which is, you can think of it as efficiency. How much revenue can a business bring in given an amount of investment? For $1 of equity investment, how much revenue did it manage to pull in that year? And then how much of that revenue was left over is net income, which it's sort of like, if this was a bank account, you would say, what did I earn this year given that I put in $100? If I make $20, that's great. If I make $1, that's bad. So return on equity. These are the two components. Compare the two companies. Putting it together, return on equity, Google is in a world of its own. 20 plus percent, 15 to 25% return on equity over a period of 5 years. Yeah, we are in 2014, end of 10 years, right? So we are sometime in 2014. SMIC, in contrast, is very unstable. One, it hardly makes money some years, it makes some money some years. Overall, it's unpredictable, unstable, and it's a horse that you cannot bet on. It's a wild horse. Meanwhile, Google was taking all the money it was making in terms of cash earnings and putting it back into the business. It was reinvesting something like 50 to 70% of its cash generation back into business. And what that did was it generated fresh revenues and growth. Basically, the new investments were generating return on equity, incremental return on equity of somewhere between 9 and 12%. That new investment was fueling growth. On the chart on the left here, you see that Google had a very high revenue growth profile. This puts Google in probably one of the top 5 percentile of 40,000 stocks in the world, for 20% annualized growth for several years. You see the red bars, SMIC, sometimes positive, sometimes negative. It's inconsistent. That's the top line. You can see the bottom line on the right. Google flat and stable and very high. SMIC, well, the numbers are so wild that we couldn't graph it easily. Anyway, this is margins. Those earnings that we were talking about, they are no good unless they convert into cash in the bank. So look at earnings quality. Google, the chart on the left is actually crazy because Google is 150% and stable. SMIC sometimes lost nearly 3,000% of its accounting earnings in terms of cash flow. That's crazy. And the chart on the right is free cash flow, which is after all the investments are left made, etc. So SMIC, you can see that in these 5 years, only burnt cash. Whether or not it made any accounting profits or accounting losses on a 5-year period, it just burnt cash. So what good is a business that just keeps burning cash? So let's just quickly recap. We had two companies which we imagined we bought in 2004 at the IPO. 10 years later, here's what happened. On the left is the summary of all the charts we looked at. The table, ROE profile, Google, very high, very good, very stable. SMIC, negative ROE. Google then took those returns that it made and it reinvested back into the business at a pretty high rate. And this reinvestment then generated incremental return on equity, which the fresh investment generated also growth, revenue growth, earnings growth, etc. And the quality of these earnings were good. They were converting back into cash, they were high, they were stable, and over a period of this 10 years, Google was generating cash that was left in the bank after paying for everything, including reinvestment. SMIC, opposite picture. So that's the last 5 years, and you're in 2015. So what you saw was that now let's say you have to make the decision. Do you now buy more stock in Alphabet or SMIC? And what can you expect from that? From what we've seen, if you summarize it, it would suggest that Alphabet will continue to do well, but maybe not as well as the first 10 years because now the company is bigger and the incremental ROE was lower than the overall ROE. SMIC is improving, but still too much of a wild horse. This is actually what happened. The green line, Google, you can see went up pretty steadily, relatively speaking. And it did compound, but like we said, at a lower rate. It's growing at about 17% a year instead of the 28% a year that happened earlier. SMIC in red, very volatile compared to the index. Sometimes good, sometimes very good, sometimes bad. You can maybe ignore this very last spike up in SMIC. That is mostly because of Donald Trump and Huawei. But you can see that from, say, 2014 to 2019, it was better because it didn't lose 90%. It only lost 20% in the worst case. And it was generally growing 25% a year, but after having lost 90%. So it's done better. And this is because the incremental ROE of SMIC was better than the overall ROE, which means their fresh investments are better than what they had when they IPO'd. Okay, let's summarize. What is a compounder? First, it's a business that has a very higher the better, return on equity, and that ROE is stable. You can always find businesses where ROE is high 1 year and down next year. That is not what we're talking about. We're talking about high and it remains high and stable. That suggests it's a special business, possibly a compounder. Then, second important requirement, it's a business that reinvests a lot of its earnings back into the business in order to generate growth. You measure this growth in the form of incremental ROE. And you can see this incremental ROE in more observable fashion in the form of revenue growth and earnings growth. And just accounting earnings is no good. That earnings has to convert into cash. That's what we call earnings quality. It's one of the aspects of earnings quality. And this cash that is generated and banked then finances further reinvestment. And this reinforcing loop makes the business stronger and stronger. And this is how you get a compounder. I mean, as usual, Charlie Munger said it the very best. Just take a minute and read for it. Okay, moving on. People have asked the question, when they did their IPO, we didn't know which of the two will end up being a Google. At the time, we couldn't tell them apart. Well, that is a good question, and it's a valid question. So here's a forward-looking question. Today, looking forward, how do you identify which is a compounder, and out of the compounders, which one is a good investment? Well, we identified compounders in my example with Google and SMIC by looking at their historical 5 year performance and asking the question, is this likely to continue? The answer was Google, yes, it will continue, but slow at a slower rate because the incremental ROE was lower than the overall ROE. SMIC, we said it will improve, but it's still pretty unstable. It will improve because incremental ROE is better than the overall ROE, but the overall bad ROE dominates. That's why it's still unstable. That's what we said. So let's, for the moment, assume that we know how to identify a compounder. But which of the compounders is a good investment? You would have made a lot of money by buying Google at a very cheap price anywhere in the first 10 years. But today, that stock is $1,500 per share. Will you still consider this a good investment? That's what we're answering here. So we know what a compounder is. These are its features. Then, when you're picking a specific stock, we look at margin of safety. A margin of safety, I recently wrote about margin of safety, and there are a couple of recent articles on my LinkedIn profile which talk about what margin of safety is, has case studies illustrating how to look at margins of safety, etc. But in summary, it refers to the beginning price that is paid by an investor. It's the valuation you pay today to buy a stock. And more specifically, it refers to whether the risk of permanent loss of the money you just invested, is that risk of permanent loss is high or low. It is permanent loss. It is not volatility. We are not talking about the stock market taking your $100 bill up and down a little bit because the market was nervous or euphoric or whatever. We're talking about you buying $1 bill for $10. Eventually it's only going to be worth $1 and you would have lost the other $9 that you paid for it. So margin of safety is the chance that you will permanently lose some of the money that you've invested. Is that probability high? Then it's a bad margin of safety, a margin of unsafety, if you like. If the risk of permanent loss of your money is low, then you have a margin of safety. Refer to the articles. It's a separate topic on its own, and I won't be doing justice by just talking about it here. Anyway, so if you combine the two concepts, looking for a stock which is a compounder, and then you buy it at a price which contains a very high level of margin of safety, then you do get stocks that generate millionaires. So the examples that we looked at. In 1996, had you bought it at the price in 1996, Dialog would have been a fantastic investment. You would have doubled your money every 2 years in that period of some 24 years. Had you bought Persol Holdings at IPO in 2008, not today, in 2008, at that price in 2008, it would have doubled your money every 15 months. But today, is it still a good investment? Well, that refers to margin of safety. Is it a good company? Yes, Google is still a very good company. Is it a good investment? Well, that depends on margin of safety. So here's a case study, an actual case study from our own experience that separates these two concepts and shows you when a good compounder is also a good investment. Again, I ask you to go back in time. We are in 2016 this time. In 2016, January to be specific, I was running a screen and I came across this stock. Never heard of this company before that. XPEL was a Toronto listed small cap back in the day. It sold sort of like a screen protector that you put on the outside of your cars to protect the paint from scratches and small dents and damage of that kind. It was doing quite well. And I won't get into too much about how the business actually works, but companies like 3M, Eastman Chemical, and a few others were its main competitors. 3M filed a patent lawsuit, and essentially in one day, the day the patent lawsuit was filed, the stock dropped 60%. So this is the backdrop. Expel. We had an advantage because we had plenty of experience with investing around US patent infringement situations, event-driven investments. And actually in 2015, we had done in-depth work on another case, which made us very familiar backwards and forwards with the whole legal process. Anyway, so that was our edge. And we knew from our experience that, a legal judgment that will put Expel out of business was maybe 5 or 10 years away. It was even 1 or 2 years away, probably 1 year away, from even getting the initial process started, which in the US is called a Markman hearing. And, after the lawsuit starts, there are possibly other scenarios. Out of court settlement, a sale of the company to somebody bigger with bigger pockets who can fight 3M, something else. They could even win the lawsuit. Who knows? So there were various other scenarios possible, But meanwhile, the stock was trading as if it was going to liquidate. The company was going to shut down in like a few days. That 60% drop. So when this was happening, we looked at the margin of safety and we took our time. We did quite a bit of research and we were making sure that we are not making a mistake. It was, in summary, one of the cheapest stocks in the entire world back in January 2016. The stock was trading at a price below the company's reproduction value. Put another way, it would cost me more money to set up a replica Expel, the plant, the distribution, the people, everything else. It would cost me X million dollars to put up a replica business. And instead, I could pay less than half of that money and buy Expel itself in the stock market. So the stock was below reproduction value, which makes absolutely no sense. And meanwhile, the company was very healthy. It was growing, it was generating cash, balance sheet was clean, etc. So, recap. One of the cheapest stocks of a healthy company, which had a very good, strong, and growing market presence, where competitors were struggling to fight against this company in the marketplace for paint protection film, the main product of the company. And then we checked if the lawsuit had any impact on suppliers or vendors, etc. And we worked the phone lines, etc., and it was good. In short, this was a case where the chance of permanent loss on the capital invested at that price, the chance of permanent loss was tiny, and the possible upside in 3, 4, 5 years was huge, enormous. So this was a case of very high margin of safety. And the stock, like I said, was a compounder. Again, look at the same 5 charts. Return on equity, off the charts, 50%, 45%. It was investing 80, 90% of its earnings back into the business. So that is the fuel for future growth. And this reinvestment was profitable. The incremental ROE was 25, 28%. Just for perspective, S&P 500 average ROE is in the order of 10, 12%. This was 2 times that. This is just incremental ROE. The overall ROE was about 4 or 5 times S&P 500. Anyway, high return on equity, high reinvestment rate, high incremental ROE from those fresh investments. That was visible in the form of revenue and earnings growth. And the earnings that the gross growing earnings were converting back into cash at a pretty high rate, 75, 80%. So this is a compounder which was also super cheap, margin of safety. Look at what happened. $100,000 in 2016, where you can probably think back and see what you were doing and which place you went on holiday in 2016. 2016, not that far away, 5 years ago. $100,000 invested in Expel in 2016 today would have been worth a very, very cool 2.2 million US dollars. Is this a stock that generated a millionaire? Yes, plenty. But it gets better. You didn't have to buy in 2016 like we did. You could have done your work and you had a good 2-year window to buy into the stock and get very similar results. But it's not always a fairy tale. It was a hell of a lot of hard work. I was waking up in the middle of the night to call people in the US, speak to car dealers in Austin, Texas, to make sure that the company's operations weren't getting affected by the lawsuit. That I spoke to law firms to see how many of them are willing to fight against 3M, whether just the fact that they're fighting against 3M will kill the company or not. There are lots of things that went into this research. It was a lot of hard work, but it shows that it's possible. And it is possible these opportunities come up, and they come up all the time, much more often than you'd imagine. The road was bumpy. Just in 2020, you would have seen that there was a 40% drawdown. Had you sold off there, you would have not seen the recovery and a new high. So it allows you to be patient. Patience is good. So let me put it all together in this one final slide. The chart on the left, the table on the left, shows you how the earnings evolved in the last 10 years for Expel, going from a piddly 2 cents a share to 51 cents a share 10 years later. Earnings per share. And look at what happened to the P, which is the last column. Went from less than 1x to 30x. And essentially, if you were to look at the stock price change, went from 1 cent a share to $15 a share. Most of that, it comes always in 2 steps. First step, earnings growth, which comes from being a compounder. We all know how to analyze and profile a compounder now. ROE, high reinvestment, high incremental ROE, which manifests as earnings growth, which manifests as high cash earnings growth. Okay, so first you get earnings growth. This is what the stock market sees. And then the analysts start piling on. And then from all that popularity and the recognition that this is a good business, the valuation multiples go up. So it's always this way. First, the earnings growth comes, then the valuation premiums go up. And the combined effect of that makes you a multi-bagger, a stock that generates a millionaire. So on that note, I would say that the future is bright. Like I said, we saw these stocks that generated millionaires in every country, in every sector, at all different times in history. And it is also going to be true for the next 10 years. So the future is bright. Good luck and successful investing to all of you. Thank you for being here. Now, I'll take a moment and maybe address some of the questions that came up along the way.
Anand?
Yes.
Yeah, this is Olivier. Will you be
Hi,
sharing the
Olivia.
slides?
Can I get back to you on that? I think we got also a couple of requests to do this event in some other settings. So,
Okay,
and let me get back to you on that.
no problem.
We'll do something that that would be interesting for people here. If you wish to ask a question, please unmute yourself and go for it. Okay. I have a couple of questions from the chat and I will take them one to one. Peter Olila. Hi, Peter. How are you? Peter's asking the question. Good example of alphabet, growth of revenue and income, that's good. But how do you link that into the market value of the company? Well, okay, so what I tried to do in this presentation was to show you that it's better thought of as two separate elements. First, you look at whether or not the business is currently a compounder, and if you have any reason to think that it will not continue to be. So, in other words, is the future going to resemble the past or not? So, in the case the future looks likely to be like the past, then it makes sense to look at the historical financials and figure out whether or not it's a compounder. So we looked at the elements that make it a compounder: high ROE, high reinvestment rate, high incremental ROE, shown itself as revenue and earnings growth and high cash earnings of that accounting earnings. So that's what a compounder is. Now the question is, how do you link it to the market value? Well, that was what the case study on Excel was about. The idea was to say, okay, now that I know this is a compounder, am I paying too much of a price for it? In the case of, basically, it pays to be unreasonable and you expect to get everything for free, in which case you will not overpay. And what we do as investment managers is we always have a ranking of 5 companies that we want to buy, and we rank them on margin of safety and we rank them on risk to reward. And when you look at it on a basis of 5 or 10 companies and say which one of these 10 do I want to buy now that all these 10 are compounders, then you get a answer of which one is a better investment, which I think is the answer to your question. If it's not the answer, then we'll take it up offline. Okay, so moving on. I have another question here. When I guess this is about Google, when they went IPO, why we didn't have the benefit of hindsight? How do we know which of them will do the magic? Well, yes, at IPO we didn't know. That's why I deliberately took you into 2014, 10 years after they have been in the public markets. And then we did the analysis of what a compounder looks like and the contrast between Google and SMIC. Also, if you remember Microsoft, I didn't start the chart in 2000 and I'm sorry, at Microsoft, I didn't start the chart in 1986 when it IPO'd. I started the chart in 1990 when the stock had gone up 600%, 6 times in, 4 years. And then we looked at it and said, okay, my God, it's still a compounder. You don't have the benefit of hindsight at IPO, but you can always look at historical financial statements and get a sense of the underlying business quality. We're not talking about valuations. We're not talking about predicting the next year's profits. We're looking at qualitative things. Is this a structurally high ROE business? Are the margins stable? Is the reinvestment good? Does it have room to reinvest, etc.? Okay. Moving on. There's a question from, I think I just addressed the question from Roy. Roy, if you have additional information, I mean, you want to discuss this further, please drop me an email and you can see that on the screen. Okay, I have another question, Malvi Shah. When making a decision to buy a stock, where would you put more weight? Okay, this is good question. So I think the question boils down to whether or not, well, if you had to pick one of the two, between being a compounder and being a stock with very high margin of safety, which of the two would you pick? Ideally, you'd want both. But in reality, what you would tend to do is you would do this not on one stock, but 10 or 20. This is what we do. We do this not on one stock, but on a handful of stocks that we've been following for a long time. So we already know the business. We already have an edge. We understand the unit economics and so on. We rank them on a risk to reward basis. And we just pick the best combination of good and cheap. So the short answer is we want both. If you buy just cheap, that's not necessarily good. It's called a cigar butt. You might make some money, but it's not going to compound and make you a millionaire and billionaire. You buy $1 for 50 cents, you wait for it to become $1, and somewhere near that $1 mark is when you sell it. But what we are talking about today is stocks that make you a millionaire, which is basically a growing dollar, a dollar that becomes $2 to $3. And so that is a different game than buying at 50 cents and selling it for $1, rinse and repeat. So I hope that answers the question, but if it doesn't, again, please, I'm happy to come back and address it offline. Then I have another question. How to identify a potential stock as a beginning investor, I suppose? Okay, this is from a beginning investor, and he wants to know how to identify a potential investment, I suppose. Okay, my understanding is, as a beginning investor, how do you identify a stock as an investment? It's not a secret. What we do is we try to understand the business, and then we kind of take a call on whether or not this is a compounder, whether or not this is a cigar butt. And depending on which one it is, we kind of have a watch list of good and cheap. We buy the ones that end up at the top of the list, and we get out of those that are at the bottom of the list. This way, we tend to avoid losses and hopefully capture outperformance. If you remember, we are performance fee only. So we don't get paid one dime, and we pay the rent ourselves, not our investors. We don't get paid one dime for just keeping the money in the bank. We only get paid when our clients make performance. So performance fee only. So what it really means is we want compounders in the portfolio. And this ranking that I was talking about of relative, taking 10, 20 stocks that you know really well, ranking them and staying near the top of that list, it's a very good practice. It will also keep you invested in a stock like Microsoft for a long time if you bought it at the right price. Okay, so let me move on. I don't know if there are... I think there's a follow-up question here, which is, are cheap stocks always underperforming? Well, like I said, the way to think about it is, are you looking at... I'll give you 3 examples. Google, like we discussed, is a compounder. It's a dollar bill that becomes $2 and $2 becomes $4 and so on if you give it enough time until the underlying economics of the business will change. So for the foreseeable future, Google is a compounder. I'll give you another example. Accenture, also a very good business, extremely profitable. Maybe even more familiar name, McDonald's, very good business. It costs them almost nothing to open a new franchise store. Between Google and McDonald's, which of the two would you think will grow double in size in 10 years? Which one has the chance? Well, it's obviously Google. It's not McDonald's because McDonald's is already everywhere. So if I have to invest in McDonald's, I know that it's not really going to grow very much. So instead, I'm going to look at, is this a good business that is managed well, being run in a shareholder-friendly fashion, etc. And then I try to buy it cheap. If I can't get it cheap, I move on. A third business, let's say, I don't know, I'm Ferrexpo. Ferrexpo is a Eastern European commodity business. They basically sell iron ore. Well, this is not a compounder. It's not also a McDonald's. It is a company that sometimes it goes through boom and bust. So when you have steel and recession, this is going to not work very well. When you have, I don't know, something like 2010, when China was spending like crazy on infrastructure and steel prices were going through the roof, Ferrexpo was a great stock to have. So if I want to buy a stock like that, I don't really care about the management. I don't really care about the growth prospects. I care almost exclusively on margin of safety. Worst case scenario, how much will I lose? And did I buy it at a price below that? So therefore, I can't lose any money. So margin of safety for cigar butts, the quality of business for what we call stalwarts, which is like McDonald's, and a combination of good and cheap for compounders. In the end, if you want to get seriously rich over a period of 10, 20, 30 years, it can't be done by buying and selling and buying and selling. It has to be done by hitching your stars onto a compounder or two or three. It's tough enough to do it that way. So with that, I think we have addressed most of the written questions. So if anybody else wants to unmute themselves and ask a question, or you have any comments on the presentation or the webinar, please do so now. Be happy to hear your comments. Okay, Peter says, appreciate the webinar. Good job. Thank you, Peter. At this point, I don't know if there is enough time. It's 6:30 p.m., exactly 1 hour from when we started. So I would say at this point, we will stop. Thank you all for spending your time. Hopefully this was interesting, insightful, and I wish you good luck, and I wish you all become the people that we will profile 10 years later in the next edition of Stocks That Generated Millionaires. I don't want to see Bill Gates' picture in there. I want to see your picture in there. So let's continue down this road. Good luck, good investing. And like I said, the future is bright. Good luck to everyone. Bye-bye.